Hi folks, David Waring again with LearnBonds.com. In our last lesson we learned about the Federal Reserve, the yield curve, and how bond prices move. In today's lesson we're going to continue our Learn Bonds in 15 Minutes video course with a lesson on investing in bond funds. So let's get started.
The primary goal of a bond fund is to provide you with easier access to the bond market and greater diversification than individual bonds. There are two primary types of bond funds: bond mutual funds and bond exchange traded funds, or ETFs for short. Bond mutual funds and bond ETFs are very similar. Both provide the primary advantage of a fund, which is to diversify your investment over a wider number of bonds. This reduces the risk that you will lose a significant amount of money if one of the bonds you're invested in through the fund defaults. There are two primary differences between mutual funds and ETFs. First, bond mutual funds are bought from a mutual fund company, either directly or through your broker. You can only buy and sell a mutual fund once a day at its closing price, which is also referred to as its net asset value, or NAV for short. Bond ETFs, on the other hand, trade on an exchange just like a stock. You can even buy and sell an ETF multiple times a day if you want. The second difference is how you're charged for them. All bond mutual funds and ETFs have an expense ratio. This is the fee which is charged to your account each year in order to cover the operating expenses of the fund. Expense ratios can be as low as 0.1% of the money invested in the fund per year and go all the way up to 1% of your investment or even higher. When buying and selling most bond ETFs, you pay a commission, which is a fixed dollar amount that you are charged when you both buy and sell the fund. Many bond mutual funds can be bought and sold without paying a commission. Many bond mutual funds also charge a sales load fee when you buy the fund. This is a one-time fee that is paid to the broker who is selling you the fund. Sales loads can run as high as 5% of your initial investment. Many mutual funds that have a sales load can also be bought without a sales load, however, by choosing a different share class. Because of this, Learn Bonds recommends not buying funds that charge a sales load. ETFs do not have sales loads, so many people think they are cheaper than mutual funds. This can be true, however, because many mutual funds can be bought without paying a commission or a sales load, mutual funds can be cheaper if you're making a lot of small investments. Bond funds can be either passively or actively managed. The goal of a passively managed bond fund is to track a segment of the bond market, such as the investment grade or junk bond sector, as close as possible. Passively managed funds are also referred to as index funds. The goal of an actively managed fund is to outperform both the passive funds and other actively managed funds in its category. Surprisingly, most actively managed funds do not beat the performance of passively managed funds in the same category over the long term. One of the reasons why is because actively managed funds have to charge higher fees in order to pay the fund manager and his or her team. The majority of bond mutual funds are actively managed, and the majority of bond ETFs are passively managed. If you'd like help choosing a bond fund, click the LB Ratings link below this video. We give simple and easy to understand advice on choosing a bond fund, as well as our top fund picks there. That's our lesson for today. Please feel free to leave any comments or questions in the comment section below, and stay tuned for our next lesson on investing in municipal bonds. For more great bond information, also be sure to visit us at LearnBonds.com, on Twitter at LearnBonds, and on Facebook at Facebook.com/LearnBonds page.